Hello, please. Is Jamie on the call?
No, I don't think he is. I think Dami is not on the call anymore.
Okay, all right, thank you.
Please, are we still here? Hello?
Yes, the lecturer will join us in a few minutes.
Okay.
He will join us in a few minutes.
All right, thanks.
Hello? Hello?
Yes.
Hello? Yes. Okay, I'm back now. I'm back. Okay, so if the class is ending,
I don't know if you are sharing a screen, but I can't
no,
see any
not yet.
screen.
Not yet. I'm not sharing anything yet. Not yet. Eh, okay. I think this should be Jami's screen. Hello? Hello?
We are with you, Saeed.
We are here, Saeed.
Yeah. So I want to know
Now
whether
with
you can.
you.
Okay, no problem, no problem. I don't know. I want to know whether you can see my screen now. I'm trying to share my screen.
Yeah, I can see your screen.
Okay. I'm having like 20 minutes left now. I don't know. I was thinking initially if we can push this class to 7 o'clock so that we'll be able to do so many things. Can
Yes,
I
please,
still
we
go
can.
ahead?
We can.
We can. Please go ahead.
Yes, we can, and that's perfect.
Yes, we can now. We can.
Okay, no problem. That's fine with me. Okay, one of the things I want to be doing today is current development, current issue. I think I've shared the document on the group chat, so I don't know. And I will still, I also like to do fair value measurement, provision, and one other 2 topics before the end of this class. I don't know how you want me to go about it.
I done.
It's fine by us.
Okay, we
Sorry.
are fine with that. Hello, you said what?
Yes, we're fine with it. But the thing is, Mr. Said, some of us were
Okay.
not on the WhatsApp group page. So I don't know if the organizers of the show can send it via email to us.
Okay,
I mean the
no
document
problem.
you are projecting
No
right
problem.
now.
No problem. The
Yes.
document. Okay. I don't know whether you supply your email address. I don't know whether you did that because I'm only trying to look at a way whereby the document will be shared with everybody. I don't know whether you supply your email address for the purpose of this session. If the answer is yes, I'll talk to the
Yes.
management. Okay, no problem. I'll talk to the
Yes.
management to share everything, yeah, so that other people who are not part of the group chat can also have access to the document. Okay, I can see
All right.
somebody raising up his hand. Okay. Okay, so I would like to start with provision IS 37. I don't know whether you are still with me. Provision IS 37, provision contingent liabilities and contingent assets. Okay, I don't know whether you can see my screen before I proceed.
You can see.
Okay, so
Your network quality is not very good.
Okay, just give me 1 second. I will change my network. 1 second, I will change my network. What about now? Is it fine now? Is it fine?
Fine, it is
It's
fine. Please.
Yeah,
better.
side,
No,
side,
it's
go
fine.
on. Let's make do with it.
Okay, no, sorry about that. Okay, IS 37 talks about 3 different things. Number 1, provision. Number 2, contingent liabilities. And number 3, contingent assets. So when they say provision, what does it mean? In accordance with IS 37, provision is a liability of uncertain timing or amount. Let me come again. Provision is a liability of uncertain timing or amount. And what does that mean by that definition? That definition means 2 different things. Number 1, it means a type of liability that the timing is certain, but the amount is uncertain. Or number 2, a type of liability that the timing is uncertain, but the amount is certain. So the question is, what distinguishes between a provision and other type of liability? Provision must have an element of uncertainty, either to the timing or to the amount. IS 37 distinguishes between a provision and other liability. And based on principle in IS 37, provision must have an element of uncertainty, either to the timing or to the amount. So in line with IS 37, the standard says before an entity can recognize provision in its financial statement, 3 criteria must be met. 3 criteria must be met. Number 1 says there must be a present obligation arising from past events. Okay, let me open my Excel so that I can explain better. Let me open my Excel so that I can explain better. So number 1 says there must be a present obligation arising from past events. So in line with IS 37, present obligation arising from past events can be in 2 different ways. Number 1, we can have what they call a legal obligation. And number 2, we can have what they call a constructive obligation. So legal obligation. And we also have what they call constructive obligation. So when I say legal obligation can be broken down into 3. Number 1, legal obligation can be broken down into 3. Number 1, legal can be contractual. Number 2, legal can be contractual. Legal can be operation of the law, and also legal can be legislation. So let me come again. Legal obligation can be contractual. For example, there's an agreement between 2 or more parties, or it can be a way of legislation. Maybe the law of the land says an entity must do this when this thing happens. And number 3, legal can also be operation of the law. That is legal. Number 1, it can be contractual. Number 2, it can be.
Said, we can't hear you.
Can you hear me now?
Yes.
Yes.
And number 3, it can be operation of the law. When I say constructive can also be broken down into 2. Number 1, constructive can be based on pattern of past events. Based on pattern of past events. Valid expectation has been created. Valid expectation has been created. Also, constructive can be based on published policies. So remember, I said before an entity can recognize provision in its financial statement, 2 criteria must be met. Number 1 criteria says there must be a present obligation arising from past events. And I said obligation. So let me do something now. Let me say recognition criteria. Recognition criteria. So number 1, there must be a present obligation. There must be a present obligation arising from past events. And I said obligation can be legal. Obligation can also be constructive. And I've broken down what legal obligation can be. And I've also broken down what constructive obligation can also be. Number 2 criteria says it must be probable. It must be probable that the obligation will result into outflows of economic resources. One of the key words here is probable. In IS 37, the standard identifies 4 concepts. Number 1 is probable. Number 2 is possible. Number 3, we have probable, we have possible, we have remote. And number 4, we have what we call virtually certain. Virtually certain. Okay. So when a liability or when an obligation is probable, what does it mean? Literally, probable means more likely than not. More likely than not. But most time in the examiner will quantify an obligation for the candidate to be able to assess if the obligation is probable, is possible, is remote, or is virtually certain. In most cases, examiner will not tell you an obligation is probable or possible or remote or virtually certain. But the question is, how do I know when an obligation is probable? It's when the probability is more than 50%. When the chance of occurrence of that obligation is more than 50%, automatically it becomes a probable obligation. Possible is 50% or less. That is possible, 50% or less. Or less. Remote is 5% or less. And virtually certain is 95% or more. 95% or more. So the question is, when an obligation is probable, what do I call it in my financial statement? I will call it a provision. A provision. What do I do to such obligation? I will recognize it in my financial statement. When I say recognize, what do I mean? I will debit somewhere, I will credit somewhere. When it is possible, what do I call it? I will call it a contingent liability. A contingent liability. What do I do to it? Based on a principle in IS 37, I will disclose it as part of the note to the financial statement. When it is remote, what do I call it? I will also call it a contingent liability. What do I do to it? I will ignore it in my financial statement. And what does that mean? I will neither recognize nor disclose it in the financial statement. And why? The major reason is the chance of that particular obligation to materialize is highly negligible. So when it's virtually certain, I will still call it provision. And what do I do to it? I will also recognize it in my financial statement. That's number 2 criteria. Number 3 criteria says the amount, even though there is element of uncertainty, the amount must be reliably measured, reliably estimated. Any question? Hello? Are we fine? Can I proceed?
Yes, please.
Yes.
Okay. So in IS 37, we have several examples of provision. In IS 37, examples of provisions include that's what we call warranty. Warranty is an example. And what is the meaning of warranty? Warranty is a promise that is made by a manufacturer of a product or a seller of a product to the customer that if this product is malfunctioning under the terms and conditions, bring this product back to me, I will fix it for you, or bring it back to me, I will refund your money, or bring it back to me, I will replace it. Okay, I'm sure Jamie must have taken IFRS 15, I'm very sure. In IFRS 15, we also have warranty as well. Please take note of what I'm about to say here. We have 2 types of warranty. One is covered in IFRS 15, another one is covered in IS 37. What type of warranty is covered in IFRS 15? The two type of warranty we have the one we call service type warranty, and we have the one we call assurance type warranty. The assurance type warranty is the type of warranty we are used to. If I go to LG shop to buy a washing machine, and LG is telling me that, oh, Said, I'm giving you a 2-year warranty. That particular warranty LG is giving to me is what we call assurance type warranty. That means the books of LG, that warranty is a provision in accordance with IS 37. However, if I go to LG shop to buy a washing machine, and LG is telling me that, oh, Said, this washing machine comes with 6-month warranty. And let me assume the washing machine will cost me 1 million naira. And I'm saying, oh, 6 months is too short for 1 million naira. And I'm asking LG, that LG, after the expiration of 6 months, can I also buy a warranty for the next 2 years? The warranty I will buy from LG in IFRS, we call it service type warranty. Service type warranty is a performance obligation in line with IFRS 15. Please take note. Warranty can be a provision if that warranty is an assurance type, and warranty can also be a performance obligation if that warranty is a service type. The accounting treatment for both of them are not the same. Please take note. So if I'm saying example of provision is warranty, the one I'm referring to is the one we call assurance type warranty. Okay, so we have warranty, which is assurance type. We have the one we call decommissioning cost. Decommissioning cost. Decommissioning cost is a principle. It's a concept also in IS 16. And what is the meaning of decommissioning cost? In some cases, they may use another terminology. Decommissioning cost can also be removal cost, can also be dismantling cost. And what does it mean? It's a cost a company will incur in future to dismantle its asset in a location and restore the location to its original condition. So what the standard is saying is decommissioning cost, because of time value of money, what I need to do is to discount to present value. The initial present value of the decommissioning cost will be debited to an asset. And what does that mean? It means I need to capitalize it to an asset, and the corresponding entries to credit it to a provision. What type of provision? What type of liability? Non-current liability. So what I need to be doing is the asset needs to be depreciated. That means if I want to depreciate the asset, what I need to do is to depreciate the entire cost of the asset, including the present value of the decommissioning. So I will depreciate it, and that means the carrying value of the... Hello? Hello?
Please continue.
Okay. Okay, that means I will depreciate the initial cost of the asset. The initial cost of the asset will include the present value of the decommissioning cost and credit the provision. Remember, what I've discounted is a future value. I need to do something. If you look at it very well, if I discount the future value to present value, and I'm comparing the future value with the present value, automatically the future value will be higher compared to the present value. There is a methodology in IS 37. And what do we call that methodology? We call it unwinding of interest. Unwinding of interest is a methodology to ensure that the present value I recognize today will be equal to future value in future. So that means if what I've recognized now is the present value of the decommissioning cost, I debit an asset, which means I capitalize to an asset, and I credit a provision. Every year, I will do what they call unwinding of interest. And in line with IS 37, unwinding of interest should be recognized in profit or loss as a finance cost. The decommissioning cost is also an example of provision. Okay, before I move to another, yes, question.
Sorry, please. The service cost warranty and the assurance type warranty, I didn't get the treatment.
Okay. Let me come again. I said in accounting today, warranty can be of two types. Warranty can be service type, warranty can be assurance type. For example, if I want to buy a brand new laptop and I walk into a shop, let's say Slot, and I'm telling them I want to buy a brand new laptop. Let me assume I want to buy a Dell, and Slot is telling me that, oh, this laptop you are buying, it comes with a warranty. Said, this laptop comes with 2-year warranty. So what does that mean? That means Slot is assuring me that the laptop I'm about to buy is fit for purpose. In accounting, that is an assurance type warranty. The question is, how will Slot recognize the transaction in its financial statement? Warranty is a provision because it has an element of uncertainty. Uncertainty in terms of what? In terms of the timing. Even though Slot is telling me that this warranty will cover 2 years, the question is, when I will come back to Slot to claim my warranty within the 2 years is unknown or uncertain to Slot. So in that case, in line with IFRS principle, that particular warranty is an assurance type and is a provision. So the question is, what should be the accounting treatment in the books of Slot? Slot with debit and expense in the profit or loss, and Slot will also credit a liability provision. However, if I walk into Slot to buy a brand new laptop, Dell laptop, and Slot is telling me, Sae, this laptop does not come with warranty. But I ask Slot a question that, okay, even though it doesn't come with a warranty, can I purchase this warranty? Can I buy it? And Slot is telling me that, oh, yes, you can buy. If you are ready to pay, you can buy. And I go ahead to pay for that warranty. That warranty I've paid for, in IFRS, we call it service type warranty. So that means, remember, there is a consideration. I've paid an amount to Slot. In line with the principle of IFRS 15, the standard that talks about revenue recognition, the standard requires that particular warranty I've paid for is a separate performance obligation in the books of Slot. That means, if what I'm doing, if what I did on day one was to buy a brand new laptop from Slot, at the same time, I also purchased warranty. That means there are 2 different performance obligations. Number 1 is the purchase of laptop, and number 2 is the purchase of warranty. So in line with IFRS 15, that service type warranty is a performance obligation, which implies that Slot will also recognize revenue on that. Remember, in IFRS 15, performance obligation can be point in time and it can be over time. If I buy a warranty, it will be for a particular period of time. That means it can't be point in time. That means it's over time. So based on IFRS 15 principle, the amount that we pay to Slot today needs to be spread over the period that the warranty covers. Using what method? Using straight line method. I don't know whether you're fine. Hello?
Yeah, thank you.
Okay. So we have warranty, we have decommissioning cost, we have environmental cleanup cost, We have environmental cleanup cost, the cost a company will incur later in future because the activity of the company pollutes the environment. Environmental cleanup cost applies to company into mining, company into oil and gas, company into manufacturing, and so on and so forth. Okay, we also have what we call honorary contract. Honorary contract. What's an honorary contract? Honorary contract is a loss-making contract. It's a type of contract whereby the unavoidable cost to be incurred in fulfilling the contract will exceed the benefit to be derived from that contract. So in line with IS 37, the standard requires that the entity should recognize the loss immediately as what? As a provision. We also have what they call restructuring cost, which I'll be talking about in my next slide. I don't know whether we are fine. Yes?
Yeah, I have a question. Okay, so for this 1 year's contract, I saw a question where, okay, it was specify that it is a 1 year contract. Now the amount to be recognized, measured and recognized, there were two figures there. The cost of fulfilling the contract, say in 2 years time, able
Yes.
you pay amount in 2 years time, and there's the cost of not fulfilling the contract, that's paying, you have to pay it now.
Okay.
You understand? So which of them would be recognized or measured as for the onerous provision?
Okay. Yeah, let me explain onerous contract again. Onerous contract is a loss-making contract. And what does that mean? It's a contract whereby the unavoidable cost of fulfilling the contract. Let's take note of something. It's not just the cost of fulfilling the contract. The cost must be unavoidable. The unavoidable cost of fulfilling the contract is more than the benefit to be derived from that contract. So what does that mean? It means if the unavoidable costs I will incur in fulfilling a contract exceeds the benefit from that contract, automatically that means the contract will result into a loss. So what the standard is saying is, what is my provision today is the loss I will make on that contract. So if examiner is giving me a question that has to do with onerous contract, I need to look at the principle in IS 37. What is the principle? The principle says the cost I need to take into consideration for me to recognize an onerous contract must be the cost that is unavoidable. So based on what you've said now, you say the examiner identified two different costs. One is unavoidable, but the other one, I don't think I get the other one. What's the other one?
Okay, the first one was the cost of the cost that you incurred in the contract, like the contract you entered into. Then the second one was
the first one. When you say the cost that we incur.
Okay, let me just read the question.
Are you looking at the entire cost? Because what I need to take into consideration is the unavoidable cost, not necessarily the entire cost, because the entire cost can include avoidable and unavoidable. But the cost I need to consider is a cost that is unavoidable. That means I can't do without the cost. That means in as much as I need to execute the contract, automatically I need to incur the cost. Maybe you need to check the question very well.
Okay.
Are you fine?
Yeah.
So, Said, my hand has no sense. So I want you to explain the difference between commissioning cost and environmental cleanup cost, and can they be treated the same way?
Not necessarily. They are not treated the same way. Let me explain again. Okay. Let me use Nigeria to explain. I have a friend that works in a telecommunication company, and sometimes like 2 years ago, the guy told me that, oh, Said, are you aware that most of the telecommunication masts we see around Lagos that are owned by this telecommunication company, in most cases, the location are usually on lease. I argue with the guy that, oh, it's not possible. I cannot lease a place because I want to erect a mosque. The guy told me, Said, calm down. The location is usually on lease. And that is a major reason why it's not possible that a telecommunication company will have land in almost part of Lagos. It's not possible. So that means if Said has a land somewhere in Surulere, a part of Lagos, and MTN Nigeria approaches Said that, oh, Said, please, I need a piece of land that I want to put my telecommunication mask just to boost network for like 5 years. Said, are you willing to enter into that contract? And I'm telling MTN that, MTN Nigeria, in as much as you are willing to pay me, no problem. What I need is money. And we enter into an agreement. Remember, the tenure is for 5 years. Automatically, for MTN Nigeria to erect a mask on my land, so many things must have been done on that land for the mask to stay without anything happening to that mask. Remember, the contract between myself and MTN Nigeria is MTN to use that land for the next 5 years. In 5 years' time, when the contract expires, I won't just allow MTN to walk away. MTN must have done something on my land to be able to erect a mask on it. If MTN goes away, I can decide to use my land for agricultural purpose. I can decide to use my land for a football field. I can decide to use my land for fish pond, whatever reason. So automatically, that means I won't just allow MTN to walk away. Before MTN can walk away, please return the land to the way you met it. What do we call that in accounting? We call it decommissioning cost. Or sometimes they call it cost of removal. Or sometimes they call it the cost of restoration or dismantling cost. They all mean the same. In accounting, what MTN needs to do is on day one, MTN needs to estimate the costs it will incur to remove those masks on the land in 5 years' time. Remember, that's an accounting estimate. And that particular amount on day one is a future value. In IS 37, there's a principle that says provision should consider time value of money. So automatically on day one, what MTN needs to do is to discount that figure to present value. That means the discounted value will be added to the cost of the mask. That is the meaning. So what does that imply? It implies the original present value of a decommissioning cost will need to be capitalized as part of the cost of an asset. That means I will debit the initial present value will be debited to an asset and credited to a liability. What do I call that liability? Is a provision. What kind of provision? Provision for decommissioning cost. Remember, the asset will be reducing every year as a result of depreciation. The liability will be increasing every year as a result of unwinding of interest. After doing the unwinding of interest, I will debit POL as an expense. I will call it finance cost. Where will I credit? I will credit the liability. If I credit liability, what does it mean? The liability carrying value will increase every year. That means in year 5, the carrying value of the liability should be equal to the original value that was discounted. That is the meaning. What do we call that? We call that decommissioning cost. That means the accounting treatment for decommissioning cost is number one, I need to discount because of time value of money. And number two, the present value needs to be capitalized to an asset. That's the principle. So let me now explain environmental cleanup cost. Environmental cleanup cost applies to company into manufacturing, company into mining, company into oil and gas, that the activity of those companies actually pollute the environment. Polluting the environment maybe in form of water pollution, maybe in form of air pollution, maybe in form of noise pollution, whatever pollution. In Nigeria, 2 years ago or 3 years ago, federal government of Nigeria forced Share Nigeria to clean up Ogoni land. So what does that mean? That means environmental cleanup cost in the books of Shell is something that needs to see. If somebody should send me the financial statement of Shell Nigeria or Mobi Nigeria or Total Nigeria, I expect to see environmental cleanup costs in the financial statement. Why? Because the activity of those companies I mentioned actually pollute the environment. And there is a law in Nigeria that says if your activity pollute the environment, you need to clean up the environment. So automatically, that means what will give rise to decommissioning cost is not exactly what gives rise to environmental cleanup cost. That is number one difference between the two. Number two difference is that, remember, decommissioning cost affects the asset. And remember the principle in IS 16. The principle says all costs that are directly attributable to an asset must be capitalized. But environmental cleanup cost is a cost that does not directly affect the asset. So what does that imply? Even though I will also discount to present value and do unwinding of interest, but the original present value of environmental cleanup cost will never be capitalized as part of the cost of an asset. Why? Because it does not affect the asset. I don't know whether you are fine.
Yeah, I'm fine. Thank you.
Hello, Said. Hello.
Yes. Yeah, I can hear you.
Yeah. Sorry, I was raising my hand initially, so you didn't pick me.
I'm so sorry.
Point you were explaining the assurance warranty and the service warranty, I got that I got the splitting, but I really want to, like, if you can help me create a scenario around assurance warranty to really be able to grab it well or better.
Okay, no problem. No problem. Okay, I will paint two different scenarios for both assurance type warranty and the service type warranty. I will paint two different scenarios. Okay, so I move now. Let me paint the scenario. Okay, I have a friend, and sometimes last year, my friend told me that he bought a washing machine, and he bought the washing machine for 1.5 million naira. Hey, to me, it was a lot of money. A washing machine for 1.5 million naira. My own washing machine at home, I think I bought it for like 60,000 naira. And he bought his own washing machine for 1.5 million naira. That's a lot of money. So, and I asked him that, Oga, if you buy your washing machine for 1.5 million naira, if I'm the owner of that washing machine, I think I will only use it once in a year so that nothing will happen to that washing machine. So the question I asked him was that, where you bought this washing machine from, they must give you warranty for life. He told me that, oh, Sai, no mind them. They only gave me 1 year warranty. To me, 1 year warranty is just too short, too small for a washing machine that cost me 1.5 million naira. So what I advised him was that, okay, even though they are giving you 1 year warranty for that washing machine, it's fine. But that 1 year warranty is an assurance type warranty because it comes with that washing machine. And I advise that, my friend, Oga, for you to be on a safer side, please go back to the seller and ask the seller if it is possible for you to buy warranty. And if it is possible, can you buy warranty for additional 4 years? So that in total, the total warranty will be for 5 years. And that my friend followed my instruction. And the guy went to the seller and asked the seller, the Oga seller, please, can I buy a warranty on this my washing machine for additional 4 years? And the seller said, no problem, if you are willing to pay. And now my friend paid for another 4-year warranty. That means the total warranty is for 5 years. That is the meaning. So let me now explain properly now. Remember, when you bought the washing machine, it came with 1 year warranty. That 1 year warranty is the assurance type warranty. But the 4-year warranty my friend paid for is one we call service type warranty. I don't know whether you're fine now.
Yes, thank you. Yes, I am. Okay. Yes, I'm fine. Thank you.
Okay, no problem. Okay. Any questions so far before I move on?
Hi, Said.
Yes.
Hi,
Yeah, so the warranty he paid for, the service warranty, will that be a separate performance obligation under IFRS 15?
Fantastic. Separate performance obligation on IFRS 15. I've said that earlier. Yes, correct.
Okay, can you hear me, please?
Yeah, I can hear you. I don't
know. Okay, thank you. Yeah, so you said the environmental cost, do we capitalize it with the assets or we recognize it separately?
We recognize it in POL. We don't capitalize it as part of the cost of an asset. We don't.
Okay, as a full expense.
Yeah, as a full expense. Remember, something on my screen so that you can understand better. Let me do something on my Excel so that you can understand. Okay. Let me paint a scenario. Let me say, okay, I'm having Let me pay two different scenarios. Let me say I have a decommissioning cost. Decommissioning cost. And that decommissioning cost is, let's say, $5 million. $5 million. Okay. The timing, let me say, is in 3 years' time. 3 years' time. The cost of capital, let me assume is 10%. Let me also assume that the cost of the assets to be decommissioned in 3 years' time. How much? The cost of the asset to be decommissioned in 3 years' time, let me say it's $10 million. $10 million. Okay? This is just an illustration so that you can understand it better. So what the standard says is that Said, consider time value of money. So consider time value of money, and therefore accounting is appropriate. So that means I will say in year one, what do I need to do in year one? The first thing I need to do, remember that 5 million is the future value. So what I need to do is to say present value in year one. And how do I get my present value? I will say bracket open, 5 million multiplied by 1.1 raised to the power minus 3. So let me now evaluate that. So I will say 1.1 raised to the power of minus 3 multiplied by 5, 1, 2, 3, 1, 2, 3. Look at the figure it's giving me. So I will do unwinding of interest. At the end of year one, I will do unwinding of interest. And what's the principle of unwinding? The principle says, say, the same discount factor, that discount rate you've used in discounting must be multiplied by the present value. So 3756,574. So what do I get? So I will say this figure multiplied by 0.1. What do I get? I will get this. That means at the end of year one, the carrying value of the provision will increase. So carrying value of provision in year one. That is the meaning. So I will come here and say year two. So in my year two, what do I need to do for year two? Remember, I've done present value in year one. So in year two, what I will only do is to say unwinding of interest. So unwinding of interest in year two is the last figure in year one multiplied by 0.1. So, and I will say carrying value of provision year two. So what will be my carrying value? My carrying value will be the carrying value in year one plus your unwinding in year two, which give me the carrying value in year two. If you look at that figure, the present value has increased to 4.1 in year one and is now 4.5 in year two. So in year three, after doing the unwinding in year three, my total figure must be 5 million. And that is the principle of unwinding of interest. So in year three, I will also do the unwinding again. So the principle of unwinding say the last figure in year two multiplied by 0.1. So the total figure in year two is in year three is this year two carrying value plus your unwinding in year three, which gives me 5 million. the original value I discounted. So what should be the accounting entry? Let me show you the accounting entry now. The accounting entry. So on day one, on initial recognition, what do? I will debit an asset, credit provision. For how much? For the present value. And subsequently, that means in year one, I will debit profit or loss. Finance cost. What will be the figure? The figure will be the unwinding of interest. And I will also credit provision. For year two, what do? For year two, I will debit my profit or loss for the unwinding year two and also credit provision. And for my year three, I will also debit profit or loss as finance cost, and I will also credit my provision. That means based on what I've done in year one, the total cost of the asset is equal to how much? Is equal to the 10 million, 10, 1, 2, 3, 1, 2, 3, plus the present value. That's it.
So for year one and year two,
you said what? Hello?
No, I just want to say year one and year two will be non-current liability, then year three will be current liability.
See, year one, year two, year three will be non-current liability. There's a paragraph in IS 37 that says decommissioning cost is a provision that should be a non-current liability. Separating the value into current and non-current is something that is not possible. The same way you cannot separate deferred tax liability into current and non-current, and deferred tax asset into current and non-current. In the same way, you cannot separate this one as well. So year one, year two, year three is still non-current liability. I don't know whether you are fine.
Even when you're going to fulfill the obligation in year three, right?
Of course, yes.
Okay.
Any question?
So the provision that is credited is as a liability, a non-current liability.
Yeah, a non-current liability.
Okay.
Are you fine? But assuming this guy was not a decommissioning cost, assuming this guy is environmental cleanup costs, what will change? Something will change. What is that thing that will change? What is that thing that
assets remain at 10 million.
That means my debit on initial recognition, it won't be debit and asset. It will be debit profit or loss. And that is the only thing that will change. Every other thing will remain the same. So what does that mean? It means assuming this guy is not a decommissioning. Okay, let me say that again. This is a decommissioning. This is environmental cleanup cost. Environmental cleanup cost. So what is changing for both of this guy is the initial recognition of the present value. If you look at this guy, I said debit an asset. This guy, I said debit profit or loss. That is the only thing that is changing. Every other thing will remain the same. So that means under decommissioning cost, the total cost of the asset, remains 10 million naira or $10 million. 10, 1, 2, 3, 1, 2, 3. Why? Because I never capitalized the initial present value. Are we fine?
Yes. So, but the
initial
assets to which you
value.
are debiting with the unwinding of this interest.
Yeah, wait to. The unwinding is not going to the asset to. If you look at my entry,
the present value, the asset to which you are debiting with the credit with the present value.
Yes.
That you calculated. You're also going to depreciate it over the life of the asset, right?
Yes. Yes. So if this asset is for 3 years, that means we say depreciation. Depreciation. What will be depreciation? Depreciation will be this guy divided by 3. That's a meaning. And for this environmental, we say depreciation will still be my 10 million divided by 3. That's the difference between environmental and decommissioning. Are we fine?
Yes, please.
Okay. Sorry, why did you write 4.5 beside depreciation under decommissioning? I thought it's the 13 that you're going to depreciate, 13 point something million that you're depreciating.
That's what I've done. That's what I've done.
Okay, sorry.
I said divided by 3, assuming the useful life is 3 years.
Thank you.
Okay.
Sahid.
Yes.
Sahid. Okay, we
yes.
recognize the present value of the environmental cleanup cost. Even though it's going to be in the 3rd year, then we'll just start making a provision for it.
Can you come again?
I said you recognize expense the present value of the environmental cleanup cost, and
Correct.
then you made a provision for it.
Correct.
Okay, thank you.
Okay, you're welcome. Are we fine? Are we all fine?
Yeah, sorry, just to be clear.
Hello. Hello, Said.
Yes.
So I believe at the end of the 3rd year, when this expense is happening, so what we're going to do then is credit back debit provision, right?
That's it.
Is that going to be the recognition of the expense?
Yeah,
of the actual outflow of cash?
Fantastic. Now listen to me. At the end of the day, if I need to settle this obligation, 3 things may happen. 3 things may happen. Let me show you those 3 things. Debit, provision. So depending on the circumstances, debit provision, debit POL, credit cash. That is scenario number 1. Number 1, I will explain. Number 2, debit provision. Debit provision. Credit cash. Credit POL. Number 3 scenario, depending on the circumstances, debit provision, and credit cash. Any question?
So I believe this is depending on the value of the actual expense.
Fantastic, fantastic. Number one scenario is if the actual amount I need to settle is more than the provision I've made. That means there is a need for additional provision, which the debit or profit or loss will cater for. Number two scenario is if the actual amount I need to settle is far, far more than the provision I've recognized initially. That means the excess needs to be released to profit or loss as what? Provision no longer required. It's an income to me. And number three scenario, if the actual amount I will settle equates the provision I've recognized initially. Are we fine?
Yes, thank you. Fire on.
Fire on. So let me fire. Okay, I've talked about the measurement. I've talked about the recognition criteria. I said there are three criteria. I've explained them. Number one criteria says there must be a present value. There must be a present obligation arising from past event. And I've told you how those obligations can come. I told you it can be legal, it can be constructive, and also told you that it must be probable that the obligation will result into outflows of economic resources. I've told you we have four terminology in IS 37. We have probable, possible, virtually certain, and we have remote as well. Okay, the measurement based on IS 37, the standard says provision should be measured based on management best estimate. Management best estimate. So management best estimate should consider what has happened in the past, what is happening currently, and what is expected to happen in future. And determining the amount of provision is a function of the type of provision I need to recognize. In IS 37, when there is a large population of items, the standard requires that my provision should be in form of weighted average. And a good example of that is warranty. A good example of that is warranty. But if the provision involves a single item, IS 37 requires that the full amount needs to be recognized in my financial statement as a provision. I don't know whether that makes sense to you. Okay, I move now. I move. That's what they call reimbursement in IS 37, reimbursement. And what does it mean? We all know the meaning of reimbursement. The literary meaning of reimbursement means for somebody to compensate me or to refund an amount that I've incurred before. So in IS 37, the standard is saying that it's possible for me to recognize a provision in my financial statement, and on the day the provision will eventually crystallize, another body or another person or another party will compensate me for the amount I will incur on that day. And a good example of reimbursement is insurance. Let me paint a scenario. There was a time I saw an advert on a newspaper in Nigeria that to buy a smartphone from Slot. Slot will give you warranty on that phone. At the same time, that phone has been insured with a particular insurance company. So that means this Slot has promised you that if the screen or the phone is malfunctioning under the terms and conditions, bring it back to Slot. Slot will fix it for you. Remember, that same phone has also been insured with an insurance company. That means if the customer returns that phone for Slot to fix the phone, what Slot will do is also to write the insurance company for compensation. What do we call this in IS 37? We call it reimbursement. So in IS 37, the standard requires that reimbursement should only be recognized in a financial statement whenever it is virtually certain that it will be received. Whenever it is virtually certain that it will be received. And the standard requires that that reimbursement should be recognized as an income, and the corresponding entry is to create a separate asset for it. What do we call the asset? The asset is a receivable. So on my balance sheet, I don't offset. I will show the assets separately. I will show the liabilities separately. But in my P&L, if I wish to offset, I may go ahead and offset. I don't know whether we are fine.
Sorry, what are we offsetting in the P&L?
Okay. What are we offsetting in P&L? The provision which is an expense. The provision which is an expense in my profit or loss, and the amount the insurance company will pay me as per compensation. So there are two ways of recognizing it in my P&L. It's either I show the compensation as other income, and I show the provision as an expense separately, or in my P&L, I show the net figure in my P&L. Are we fine?
Yes, fire on.
Okay, before I fire on, I want to show you something. I hope you're
still going to be able to treat current developments.
The way side is going, we might finish 10 p.m. today. 10 p.m.
Although the current development, I've sent it to the group chat. It's something that we can read up. If you have challenge, let me know. We can create time for that if we have challenge. But I believe it's something you can read up on your own. Hey, about there is fire on the mountain.
Sorry, which group chat? Is it the WhatsApp?
Yeah, the WhatsApp group chat. Yeah, for those people that are on the WhatsApp. For those people that are not on the WhatsApp, I will send it across to you. In as much as you provide your email address, is not a challenge. It's not a challenge. I will do that. And I will drop my phone number in case you need anything. You can reach out. Okay. Hey. About. Can you see my screen? Can you see my screen?
Yes.
Okay. Can somebody read question number 1 on IS 37? Question number 1.
Sorry, Said. Just to clear on the group chat. Which exactly the group chat WhatsApp group for the class of the one created today? Because we on the one created today, we are yet to receive it.
Wait. Okay. I don't know. Okay, they created a WhatsApp group today.
Yes.
Yeah. Yes, for the revision class.
Hey. Oh.
Yeah, it's fine.
I don't think I'm part of it. Don't worry. I will talk to the management to add me to it so that I can drop it on that platform as well.
That'll be fine.
Said, I'm actually thinking that the current developments is a lot, and we have not even been taught at all. So I was thinking that you should probably run over it. You could send us solutions to this.
Okay.
Because that was what Jamie said we were coming to do, current developments.
Yeah, I think I like that idea too.
Okay, that means I can abandon this guy, Abby.
Yeah, you can send us
a You can send us a solution if you have it.
Okay, so I will send you the solution. So let's fire. Can you see my new screen now?
How many minutes will you take to finish the current development?
Okay, it depends. Yeah, it depends. So it depends. If you look at, okay, it depends on so many factors. If you look at this slide I'm having here, I have 54 slides. 54. Wow. 54. So how do you want me to do it? General overview? I don't know.
So you just fire. Okay. Overview, fire anyhow. The one that is enough for us to get the marks in the exam is okay.
Okay, but remember this current development. Okay, no problem. Let me fire because this current development is like an add-on to the normal standard you know already. So there will be amendment. I'll be talking about so many amendments to so many standard, so many amendments, blah 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 blah. I'm sure you must have done IS8 class.
I say.
Yes.
Please, if you put on the fire now, when will this fire go off? Because it's already 13 minutes to 7.
But are these proposed, are these exposure drafts, are they examinable?
Yeah.
I think by the time you have written on all the existing standards, you would have scored your mark. This let's read up this one. Let's face the one that's already in existence and read up this one. If you ask me on my opinion.
Yeah, that was what I thought as well. That was this is a lot. Yes.
Please, is there difference between current development and current issues? If there is, what are the difference?
They are the same thing. The same thing.
And also, please, can you touch on cryptocurrency as regards IFRS?
Oh, I thought
there's an article for cryptocurrency. There's an article for cryptocurrency under technical article, and it's well explained there. You can't even miss it. Very interesting.
Yeah. Okay. Wait. Jamie did financial instruments today.
I don't think I have material.
Oh yeah, wait. Jamie did financial instruments today, Abby.
Yeah, he just touched on,
It was an overview.
An overview, yeah.
Okay. Okay, so I don't. Oh yeah, wait. What do you want me to do now?
Overview.
Of what? What of this current development?
Yes.
No, I don't know how to.
Time has gone. Forward.
I don't know.
My head very full like this.
At least let him start now. Let him just start. By 7, if we need to stop, we stop.
Wait. That person that has a question on cryptocurrency, please, you may need to. Okay, I don't know whether I should explain cryptocurrency or the person will read it up on that technical article.
Who read it up? The person who read it up.
It's well
the
explained.
challenge
Thank
is
you.
I don't know the material specifically. I don't. If it's probably I'm not aware of the material, or probably
Send me your
know
number.
the exact material.
Call your number.
Okay.
I'll send it to you.
Oh, okay.
Voila. So let's move. I have less than 20 minutes. Are we ready?
Make it 10. You have less than 10 minutes.
Okay, no problem. Okay, so financial instruments with characteristics of equity. Now listen to me. When Jamie did financial instrument, Jamie must have mentioned, I don't know whether he was able to mention that, but because of time constraint, maybe he didn't mention that. That's what they call compound financial instrument. Do you know the meaning?
Yeah, you mentioned
Yes.
You mentioned it.
Okay. A compound financial instrument is a financial instrument that has features of financial liability and features of equity. In accordance with IS 32, the standard requires what we call split accounting, which means that instrument, I need to separate it into the component that relate to financial liability and the component that relate to equity. And there are principles stipulated in IS 32 for that purpose. So this one is talking about financial instrument with characteristics of equity. Okay, so the main objective is to identify the characteristic that should be present in an instrument for it to be classified as either equity or as a liability. Okay, I'm very sure, I don't know as well. Maybe Johnny must have taken you in class as a normal class, or maybe he must have mentioned it today. One of the major questions that comes out for exam purpose that we must know is how do I differentiate between a financial liability and equity? We must know it. It's a must. I don't know whether I should just run through this slide the way it is, or for me to explain it properly. I don't know. Just tell me what.
Jeremy has explained.
Oh, Jeremy has explained. Fantastic. So this one is talking about sometimes if I have a financial instrument in my financial statement, sometimes it may be difficult for me to identify if that financial instrument is a liability or that financial instrument is an equity. IAS 32 talks more about the financial liability part, not really the equity part. And there are several parameters or things that I need to consider for me to say, oh, this instrument is a liability or this instrument is an equity. And if you look at it very well, we have a revised conceptual framework that provided a new definition for a liability and also definition for equity, including the recognition criteria for both of them. So this one is just talking about if I have a financial instrument in my financial statement, I need to be very careful for me to present it in my financial statement because presentation can affect the financial statement. If I have a liability that I've presented as an equity, it will distort my financial statement. At the same time, if I have equity that I've presented as a liability, it will also distort my financial statement. So what I need to do is to look at the characteristics of the instrument and I'll evaluate based on the principle in IAS 32. And if there are any challenges, I go back to the conceptual framework. And a revised conceptual framework provided a revised definition for equity, a revised definition for liability, including the recognition criteria for them. Are we fine? Can I proceed?
Yes.
Okay. If you look at it very well, based on what IAS 32 has stipulated, IAS 32 provides sufficient guidance for me to differentiate between instruments that are equity and instruments that are financial liability. And if I'm having instrument that is looking like equity and liability at the same time, what the standard is saying is that that instrument may be a compound financial instrument, and I need to use the principle in IAS 32 for me to separate the instrument into the portion or the component that relate to financial liability and the component that relate to equity, looking at their characteristics. And the characteristics based on the revised conceptual framework also is in line with the same characteristics in IAS 32. That means it remains unchanged. Okay. About deferred tax. Deferred tax. IAS 12. So deferred tax related to an asset or liability arising from single transaction. What causes deferred tax? We call it temporary timing difference. Temporary timing difference will give rise to deferred tax. And deferred tax can be a deferred tax asset or deferred tax liability. What gives rise to deferred tax assets? In accordance with IAS 12, 3 things give rise to deferred tax assets. What are those 3 things? Number 1, unutilized tax credits. Number 2, unutilized tax losses. And number 3, deductible temporary differences. The question is, what gives rise to deferred tax liability? In accordance with IAS 12, the only thing that gives rise to deferred tax liability is what we call taxable temporary differences. So in most cases, a single transaction in most cases will either give rise to deferred tax assets or a deferred tax liability, depending either that transaction is a deductible temporary difference or taxable temporary difference. But what this one is talking about is deferred tax related to assets and liability deferred tax that relate to asset and liability simultaneously from a single transaction. Simultaneously from a single transaction. Okay, so this is a proposed amendment to IS1. IS1 talks about presentation of financial statements. In IS12, there is an exemption from initial recognition of deferred tax assets and also deferred tax liability. So the initial recognition exemption will not apply to transaction in which both deductible and taxable temporary difference arise on initial recognition that results in the recognition of deferred tax assets and deferred tax liability simultaneously. A good example is lease. I'm very sure you must have done lease today. I'm very sure you must have done lease today. Okay, everyone, now listen to me. Listen to me. Let me explain this one properly. Unfortunately, I don't know how to rush. I don't know how to, maybe I need to learn how to rush. I don't know how to rush. Please permit me permit me to explain this one in detail. Please, I'm begging you, permit. I don't want to rush this one. Permit me to explain this one in detail. So in IS12, what the standard is saying is, if I have an asset or I have a liability, a single transaction, ideally a single transaction, will not give rise to deferred tax asset and deferred tax liability simultaneously. Ideally, a single transaction can result into deferred tax asset only or a deferred tax liability only. But in certain circumstances, a single transaction can give rise to both deferred tax asset and both deferred tax liability. And I have examples. I have two examples, two different scenarios. Number one is lease. In accordance with IFRS 16, IFRS 16 requires that from the perspective of the lessee, all lease transactions, a lessee should recognize two different things. Number one, right of use assets, and number two, a lease obligation, except under circumstances when there is an exemption to that. And what are those exemptions? Those exemptions can come in two different ways. Number one, if the asset is a low value asset, or number two, if the lease is considered to be a short-term lease. Except for those two categories, a lessee should recognize both right of use asset. A right of use asset is an asset in the financial statement. What type of asset? A non-current asset. That should be any other directly attributable cost. At the same time, if I've entered into a transaction now, let me assume I have a company, the name of the company is Said Enterprises, and I've leased an asset from ACCA. In my financial statement as a lessee, I will recognize two different things. Remember, it's a single transaction, but I will recognize two different things. What are those two different things? A lease obligation that is a liability in my financial statement, and a right of use asset that is an asset in my financial statement. If I'm using the principle of IAS 12, one of them must give me a deferred tax asset, and one of them must give me. Another example is decommissioning. I've explained decommissioning today. I told you decommissioning on its own is a liability that should be recognized in the financial statement as a non-current liability. However, I told you that the initial present value of a decommissioning cost we need to be capitalized to an asset. That means decommissioning cost, we have two legs. Even though it's a single transaction, it will have two different legs. One leg in the obligation, which is a liability, a provision, a non-current liability, and the other leg as part of an asset, which is a non-current asset as well. That means for a decommissioning as well, even though it's a single transaction, and we have both deferred tax asset and we also have both deferred tax liability. I don't know whether that makes sense to us. Hello, my people.
Yes.
Okay.
Yes.
No, well, I've heard you. What other? It's 7 o'clock already, but let me continue
It's
moving.
7:01 already, Said. It's 7:01.
So what should we do?
Said, is it possible to do a recording of this current development and send it to us?
It's being recorded already.
No,
It's
like
being
it
recorded.
should
Let's
explain. No, I mean it should
6
explain the all current developments, then send the recording since time is not on our side anymore.
Okay,
yes,
as
no,
a separate
Said
recording.
continue. It's being
Yes, as a separate
Said.
recording.
If you could
Yes.
do
It
a
is being
summary,
recorded. Said continue. If we
There's
anybody
no
that
time to
drops and
continue.
wants
You can't continue because it's been long.
say that. You can't say that now.
You can't
It's
tell him
not.
to continue seriously.
I think it depends. It depends on.
Continue.
You can't say you should continue. We're tired now.
If you're tired, you can drop off and
You
send the
can do a
class
separate
report.
Please, we've been here since
No,
9
no,
a.m.
no.
now.
But
Please.
Saeed,
class is
Ivy
supposed
League
to
said
end by
6 p.m.
6,
Yeah,
7.
that
We've
was
been here since
published
9
information.
a.m.
7
Okay,
already
no,
now.
It's 9
Robbing
a.m.
you.
Do you know what I will do? Do you know what I will try to do? I will try to do the video and send it across.
Thank
I'll try to
you.
do the video and send it across.
Thank
No
you.
problem.
We appreciate that.
No wala. So if you have any challenge, don't worry. You can drop it on a group chat, or maybe you can send it to me personally. Don't worry. We are going to treat any form of challenges you have. So thank you very much. I wish you
Sai,
best of luck.
please don't forget to drop it on the group, the revision class group.
No problem. Oh, although I don't think I'm a member yet, but I will tell the management to add me to the group chat so that I can drop whatever I want to drop.
Okay, thank you.
Thank you.
About this, sorry, this before you go about this job. You know, some of us are not in the page. So please be kind by sending me their email. Also, I don't know.
Of course, I will talk to the management. You know, I asked a question initially whether you also supply your email address, and you say yes. You say yes. So if you supply your email address, automatically I will talk to the management. I will give the management the materials, and I will tell them to send it across to people who are not members of the class.
Okay. I was even referring to the recording that you want to do. So
Oh,
even
no
if you
problem.
share it,
No problem. No.
right,
Okay. I don't know whether the recording will be able to go to email. I will try and do that. No problem. We are working for you. In Ivy League, we are working for you.
All right. Thank you very much.
Okay, now I wish you best of luck. Congrats in advance.
Sai.
Okay, now.
Thank you, Sai.
Thanks.
Thank you.
Good night.
Thank you very much, Sai. Thank you very much.
Remember, exams are meant to be passed, so just try your best.
Thank you.
Okay, now. Thank you.